Hello everyone, welcome to all. In this video, I am going to discuss the topic Basic Accounting Concepts from Chapter 2 Theory Base of Accounting. We all do accounting, right? Yes, everything will have certain rules. In mathematics, we apply formulas for solving the problems. Like that, to ensure uniformity and consistency in accounting records, certain rules or principles have been developed which are generally accepted by the accounting profession. The rules and guidelines used in preparing accounting reports are termed as generally accepted accounting principle, that is commonly known as GAAP. These principles are also referred as concepts and conventions. The basic accounting concepts are the fundamental ideas or basic assumptions. On the basis of these assumptions, the financial statements are prepared. Now, let's look at the basic accounting concepts one by one. Business entity concept, money measurement concept, going concern concept, accounting period concept, cost concept, dual aspect concept, revenue recognition concept, matching concept, full disclosure concept, consistency concept, conservatism concept, materiality concept, and objectivity concept. Shall we discuss them one by one? First one is business entity concept. The concept of business entity assumes that business has a distinct and separate entity from its owners. It means that for the purpose of accounting, the business and its owners are to be treated as two separate entities. For example, when a person brings some money as capital into his business, in accounting records, it is treated as liability of the business to the owner. Similarly, when the owner withdraws any money from the business for his personal expenses, it is treated as reduction of the owner's capital. Second one is money measurement concept. The concept of money measurement states that only those transactions and happenings in an organization which can be expressed in terms of money, such as sale of goods or payment of expenses or receipt of income, etc., are to be recorded in the books of accounts. All such transactions or happenings which cannot be expressed in monetary terms, for example, the appointment of a manager, capabilities of its human resources, or creativity of its research department, etc., do not find a place in the accounting of a firm. Third accounting concept is going concern concept. The concept of going concern assumes that a business firm would continue to carry out its operations indefinitely, that is, for a fairly long period of time, and would not be liquidated in the foreseeable future. This is an important assumption of accounting as it provides the very basis for showing the value of assets in the balance sheet. Next one is accounting period concept. Accounting period refers to the span of time at the end of which the financial statements of an enterprise are prepared to know whether it has earned profits or incurred losses during that period. Then the next concept is cost concept. The cost concept is historical in nature as it is something which has been paid on the date of acquisition and does not change year after year. The concept requires that all assets are recorded in the books of accounts at their purchase price, which includes cost of acquisition, transportation, installation, and making the asset ready to use. Next concept is dual aspect concept. Every transaction has two aspects, one receiving aspect and one giving aspect, which means for every transaction there is a debit and a corresponding credit. This concept states that every transaction has a dual or twofold effect and should therefore be recorded at two places. In other words, we can say that at least two accounts will be involved in recording one transaction. Dual aspect is the foundation or basic principle of accounting. It provides the very basis for recording business transactions into the books of accounts. The duality principle is commonly expressed in terms of fundamental accounting equation, that is, assets is equal to liabilities plus capital. Okay, shall we move to the next concept, which is revenue recognition concept? This concept is also known as realization concept. The concept of revenue recognition requires that the revenue for a business transaction should be included in the accounting records only when it is realized. Here arises two questions in mind. First one is what is a revenue? And the second one is when the revenue is realized. Let us take the first one, that is revenue. Revenue is the gross inflow of cash, and second one is revenue is realized, right? So revenue is assumed to be realized when a legal right to receive it arises, that is the point of time when goods have been sold or service has been rendered. Thus credit sales are treated as a revenue on the day sales are made and not when money is received from the buyer. Next one is matching concept. This concept states that expenses incurred in an accounting period should be matched with revenues during that period. For example, expenses such as salaries, rent, insurance are recognized on the basis of period to which they relate and not when these are paid. Similarly, costs like depreciation of fixed asset is divided over the periods during which the asset is used. Next one is full disclosure concept. The principle of full disclosure requires that all material and relevant facts disclosed in the financial statements and their accompanying footnotes. For example, change in the method of valuation of inventory like FIFO or LIFO may be disclosed. Next concept is consistency concept. This concept states that accounting policies and practices followed by the enterprises are uniform and are consistent over the period of time. For example, same method of valuation of inventory and the same method of charging depreciation should be followed. Next one is conservatism concept. The concept of conservatism provides guidelines for recording transactions in the books of accounts and is based on the policy of playing safe. The approach of providing for the losses but not recognizing the gains until realized is called conservatism approach. The concept of conservatism requires that profits should not be recorded until realized, but all losses, even those which may have a remote possibility, are to be provided for in the books of accounts. Then, materiality concept. The concept of materiality requires that accounting should focus on material facts. Efforts should not be wasted in recording and presenting facts which are immaterial in the determination of income. The question arises here is that what is a material fact? The materiality of a fact depends on its nature and the amount involved. Stock of pens, pencils, paper, scales, etc. are not shown as assets, but it is treated as stationary expenses whether consumed or not. The last concept is objectivity concept. The concept of objectivity requires that accounting transactions should be recorded in an objective manner, free from the bias of accountants and others. This can be possible when each of the transaction is supported by verifiable documents or vouchers. For example, the transaction for the purchase of materials may be supported by cash receipt from for the money paid. The objectivity concept requires that the amounts recorded in the accounting records should be based on objective evidence. Let's conclude our session. We learned about basic accounting concepts. Hope you all understand the concept of accounting concepts. Thank you.